Our first speaker this afternoon is Kerry Boulton, founder of the Exit Strategy Group. Kerry was the first woman to manage and own an international freight forwarding company when she negotiated to buy out of Freight Management International, a division of the publicly listed company Nicholas. Kerry then moved into business coaching in the 90s before it became trendy, and then into real estate with her late husband. Kerry now helps business owners get their business ready for sale and exit in a prosperous manner. Please welcome Kerry.
Thanks, Rob. I should let everyone know, and thank you to Brodie for being the courier for Mark, who's our jeweller in Sydney and coming to learn today as well. I had a very precious pair of earrings, one of which I lost this year when I was down at the local footy club doing what volunteers do at a footy club, working in the canteen, of course, and everything else. And I was a bit devastated because I'd had it for about 40 years. Mark made me a new pair, exactly the same. And I had the one I had left, he turned into a little pendant for me to put on my other pearls that I have. So I was so thrilled. And then he rang me yesterday to tell me that he wasn't well, but he was going to send Brodie with the delivery. How good is that? Yeah. So would we...
Christmas is fast approaching, so we know who to go to.
Yeah. So I think that's a particularly interesting example of what we would call customer experience, would you not? Yeah. Which is, of course, something that we've all learnt about here as well. Now, I'm going to get you to just try to cast your minds back, if you can possibly think of a time that was a very long time ago. And that's Trevor, welcome. It's 1968. Now, I know for Brodie and a few others here, that's way too long ago, okay? But imagine it's that time. You're 15 years old. You've been homeschooling yourself for the last year because your dad is dying from cancer. And you're on your own with your sister. Your mother had died when you were 4. But you were raised by your grandparents in a loving family. And then your father remarried when you were 10, but that was pretty sad for the family because 2 years later he was diagnosed with a brain tumour and passed away 3 years later. So your stepmother had to go out to work to support the family. And your life was a little bit different. So by the age of 16, having homeschooled yourself, you found life had to be different. So the stepmother couldn't cope with 2 teenage girls. So 16 years old, you find yourself out in the workforce. You've done a secretarial course, so you know how to do shorthand and typing, which is really good because in 1968, as a female, you couldn't do much else. You could be without going to school and getting a third tertiary education. So at 16, you decided you were going to educate yourself even further by working alongside the most influential and important people that you could find and learn from them. Now, have you got the picture? Well, that you, of course, is me. So one of the things that I figured out back then was that to educate yourself, you had to work alongside really smart people. And that's what really did bring me to today. So I feel like I've gone full circle. And I don't have to tell you how long ago that was. So in the course of the next 15 years or so after that, I went to every short course you could possibly think of, and that didn't cost me anything because I didn't have much money. And so it led me ultimately to be the first female general manager at Nicholas, a large public company. Now, some of you may know of May Nicholas. It's gone by way of acquisition to all sorts of other different fields today. But you know what? I am so grateful for the lessons that I learned along the way. And on reflection, that resilience that was ingrained in both my sister and I, quite frankly, was something that not everyone has an opportunity to have. But for me, it was the beginning of what has become the end game. Because May Nicholas decided, when they looked ahead strategically, that they wanted to sell the business for which I was general manager, which was Freight Management International, FMI, a large logistics business. Think logistics, majority of men in this room, and me as a woman. So it was actually a great opportunity because I stood out from the crowd because I was a female, which was great. However, how do you buy a business or how do you sell a business when you know nothing about it? And back in those days when that opportunity came along, I did put my hand up and said to my operations director I was interested. Now, I had no idea how to buy a business, none whatsoever. But I was gung-ho because I was only 35, because that's what you are, okay? Anyway, so what can I say? I came across this book. Some of you may have heard me give you this little talk earlier this year, and thank you to Robert for allowing me to bookend the year. I came across this little book called Business Plans That Win Dollars, just been published out of MIT in the States. Stanley Rich and David Gumpert. You can see it's got my post-it notes in it and all dog-eared and everything. Of course, it's been usurped today because there's a lot of stuff that goes on today that wasn't in this book. But back then, it had just been published. So I wrote away for the book, which is, of course, what you had to do, cut out coupons in a piece of paper, in the newspaper, send them off, send off the credit card details, wait for the book, read the book. I wrote the plan by the book. My wonderful friend and mentor said to me at the time, "You write the plan, Kerry, I'll help you get the money together." I was married. I also happened to be 7 months pregnant with the first child. So I signed the deal. Well, no, that's a lie. I was supposed to sign the deal, but my daughter decided to come a month early. So the day that I was due to sign, I was in the hospital, waddled over to the public telephone and just rang and said, "I'm sorry, I'm not coming. You can come to me if you like." You know. Anyway, obviously, the rest is history, as they say. But I only relay that particular part. I want to relay that particular part of the story because in the book, it told me that I needed to have an exit plan. So I understood I needed an end game. What was it all about? Now, I decided that I was going to grow the business. That was the plan. We were going to grow the business and that we're going to sell it somewhere between the 5 and the 10-year mark to an international group. It was 83 staff, 5 offices around Australia, 120 international agents to deal with. So decent sort of a business. And it was, in fact, the beginning and the end game that worked. Everything else in the middle, stories for other days. You name it, like every business, a roller coaster through every possible activity that you could imagine. Black Monday, state managers being killed in car accidents, second children, recession we have to have, you name it, it happened. So all of those things that go through in roller coasters. But everyone, I think that the story I really want, or the underline here I want to give to you is that you have the power to get whatever you want. You really do. So if you listen up, I'm going to give you some hints and tips, hopefully, that'll help you get to where you want to be at the end of when you've actually figured out your end game, if you haven't already figured it out. Everyone exits their business one day. Let me say that again. Everyone. exits their business one day, whether you want to or not. And it's simply because we're human. Peter's business is a growing business. He's a funeral director. The market is steady, okay? Yep, absolutely. All right, so let's see if the clicker will work today. Next. I think. Oh, there you go. Okay. Oh, I've gone one. That's right, isn't it? Let me see. That's it. Okay. So that's what we're all about. So it's about the end game. And it's really, it's really about fun to think about how's the movie going to end. I think that's a really good analogy. When people make movies, they don't ever just start it without thinking about how the movie's actually going to end. So I think it's really, really fun to actually consider that as a great analogy. And we want you to have your ultimate reward because that's exactly what you'll have. So I wanted to just give you these quotes from John Warrilow. And John is the author of these 3 books, Built to Sell, which he wrote in 2012, which is actually about how you can transform any business, transforming your business into a sellable asset. And it's a great read. It's only a small book. 2015, he wrote The Automatic Customer, which is how any business can create recurring revenue in their business. And the last one, which he wrote in 2021, I think it was, The Art of Selling Your Business, which is the culmination of having interviewed over 100 different entrepreneurs and how they've moved on and sold for their businesses. So, and let me say that today, what I'm going to give you at the end, you'll see there's a QR code there for you. Everything I talk about is going to be in an ebook called The Endgame, which John's Value Builder group has pulled together. So by all means take notes, but know that you'll be able to get it if you'd like to have it. It's there as a complimentary gift for you at the end. So the next slide. One of my other, so today's session, we're going to craft the clear vision, hopefully help you to chart your course, how you can find the right strategic buyers, how you can calculate the specific amount that you'll need to earn from your business exit to live the rest of your life comfortably, and how you can manage your risk as you move closer to your end game. I've got to resist the temptation to jump ahead all the time, okay? Thanks, Wendy. Okay. All right, here's our first little mentee. Have a look at this fun slide. Tell me where you think you're at in terms, when you're in your own business, tell me where you think you're at right now, and we'll see where the group comes up. So, starting up, the nightmare phase, the survival phase when you're just getting over the startup. Are we in the growth phase? Are we in the scale and systemize phase? Ready to sell and move on? Have we moved on? Yes. Glad to see that.
Yeah.
Kerry, can you just let me know who those 2 people are in the ready to sell phase?
Yes. How we got? We got
I think Kerry would like mine as well.
the scale and systemise phase. That's good. A few more in the growth phase. We've got one in the nightmare phase.
They're all in the nightmare phase.
Okay, one in the tragedy phase. All right. Excellent. Have we all done? Done? That's really interesting. It's good to see where everyone sits. I think what you're going to hear then as I go through the presentation today is actually going to probably be of really, really good help for probably everyone but in the tragedy phase. Don't have to own up who you are. It's okay. Thanks, Wendy. Yeah, okay. Now, I'm sure you've already heard this one many times from Stephen Covey from the 7 Habits of Highly Effective People. Begin with the end in mind. It's probably a cornerstone, and we see it everywhere. If you begin with the end in mind, you really can focus on where you're going, which is what this one's all about. So we're talking about training versus jogging, and the way we want to describe this is that just a story I can remember way back in the early 1980s. I decided that I wanted to really get fit because I had a particular competition that I wanted to enter, and to do that, well, I was still, reasonably fit and just doing what you normally do with your normal exercise. But to get this, I actually had to drop 10 kilos, which was a lot for me. Right now, I could drop 30, which would be great, But I'm not quite as motivated as I was back then. But it was a case of, okay, I've got this particular competition I want to go for. I've got 3 months. What am I going to do? I really focused on getting that weight off, getting myself fit as much as I could. At the time, the business that I was working for was on the 14th floor of 520 Collins Street. Every day I would walk up the steps at least twice and down, up and down the steps at least twice, which was an incredible training regime. And it was just amazing what I achieved in those 3 months. But it was a focus that I had. So I was really focused on training to get to that particular goal. It wasn't a case of just doing your normal exercise to stay fit. And even John Warrilow also has a lovely story about how he's training right now for the Kona Ironman for the in Hawaii, for the 60 plus age bracket, and the same thing. He's hired a personal trainer and his diet and everything else, and he's now focused on training hard for that. He's always been a runner, but he's just, as he said, he was jogging rather than training. And so once you get to the point of really understanding what you're going for, what your end game is, it's the focus that actually gets you there. Thanks, Wendy. So there are 4 questions that every business owner, every founder really needs to answer. And that is, what's your end game? What is it? Number 1. Number 2, secondly, by when? And, what's your best before date, if you like? When do you want to be out of your company? How much money are you going to need? How much do you want to pull out? Is it a dream number that you aspire to? Or have you sat down and, which it is, for a lot of business owners, I want to grow my business, I want it to be worth $10 million or $20 million or whatever it might be. What's your dream number? Or is it that enough to do whatever you really want to do whenever you really want to do it. So what's that number for you? And then how close are you to that number today? What are the strategic decisions that you need to make to close the gap in that number? So once you understand your answer, and it's personal, it's very personal to every single one of you, then you'll start training rather than jogging. That's the analogy that we've drawn from that. So, okay, let's start with the first question. What's your end game? So we actually asked that question on the Value Builder questionnaire, and those who are here who actually did it when I did my first presentation at the beginning might recall this was one of the questions. And can you put a value on your company? The Value Builder questionnaire gives you a value if you've put your numbers into it. And so we do ask, what do you plan to do? Is it going to shut down? Are you going to pass it on your kids, etc., etc.? And thanks, Wendy. Yep. And you can see here from this slide that less than 1% are going to shut it down. Only less than 10% want to pass to the kids. 23, nearly a quarter, plan to transition to the next generation of managers. And by far, the majority plan to sell to a third party, so 61%. This is taken, these stats are taken from the most recent 20,000 business owners who've completed the Value Builder questionnaire, so very, very recent statistics. There's over 80,000 have done it now. So if that's, if you're selling, look, we're going to have a look at each one of them just very briefly, but if you're thinking about selling to the kids as the first ones, 1 in 10 business owners, well, there's a great podcast that John does called Built to Sell Radio, and episode 446, want a number, 446, is with a guy called Tom Deans that I've also had the pleasure of meeting personally, talks about family business, and I use his questionnaire all the time for families. And I've also done the full accredited course as a family business advisor as well. So, but lots of pros and cons in every single one of them. But if it comes to the kids, I think, yeah, those are the three. I think the next one also just says transition to kids. Yes. Okay. Oftentimes the kids don't want the business. They are, and they don't have the money to buy you out for a start. That's the thing. So the question becomes, well, how do the kids get enough money to pay you for the business? Well, you can be often left in the business for a long time on an earn-out. And it means that you need to just accept the proceeds over a longer period of time. And obviously sometimes things go gangbusters and they do much, much better than you would have done, but sometimes they don't. So you're leaving it in the business and you are going to be paid out over time. So there's a risk, but it can also cause problems in a family. So there are pros and cons with each one of these. So just want to highlight that that's there and it happens. So the next one, much more common, is that 1 in 5 say that they want to transition to their managers. I'm in the process right now of helping a client transition to his manager. We're already 12 months down the track because the manager's so busy in the business that he hasn't had enough time to concentrate on the transition, even though he's desperate and he really does want to have the business. So we've put the deadline in place for the end of this year. And it will happen, but it's taken us 12 months to even get to this point now. So it's very much a legitimate exit option and a good one for people, but it's usually frictionless. So that's what May Nicholas did when I bought the freight management business. So that was frictionless, everything was still operating. So it's just a case of over time, and it can be a bit slow to transition your business that way. And the third and most popular way is to sell to a third party. And this strategy can be broken down into three subcategories, although there's more, but let's just concentrate on these in a sort of general way. You could sell to an individual, you could sell to private equity, you could sell to strategic. So let's have a look at each one of those now, and we'll just have a look at some of the pros and cons for each of them. So there's probably more pros and cons than this, but let's just have a look at them in general on the surface, as I said. So some of what I'm going to relay to you is what's come out of the interviews with people that over all of those podcasts that John Warrilow's done. And it's, if you haven't already subscribed to Built to Sell Radio, I don't get anything for you subscribing to Built to Sell Radio, but if you haven't already, it's well worth it because there's some fantastic interviews that are there. When you sell to an individual, you are selling to a human being. So you do get to look them in the eye. You can strike a deal, you can shake their hand, and hopefully it's going to go well. Hopefully it's going to go very well. So it's got pros to it. And that individual will very likely understand the idiosyncrasies of your business, and they will want to hang around and help you, and you'll probably want to hang around with them and transition the business to them as you transition. So, and they probably will want to honour your legacy. Most business owners want to see that happen. I know that when I sold the freight business, one of the things that was the most important to me was that I wanted those people to make sure everyone had a job but me. I was fine with that. So that was really, really important to me. So, those sorts of legacies you can usually negotiate pretty successfully with an individual. But some of the cons is that sometimes the individuals don't necessarily have enough money to buy your business. So they might have to get a loan to do that. And they might have to qualify for that loan, in which case your business is going to be looked at closely, perhaps by a lender, to provide some equity, and there'll be a few hoops that you have to jump through. And only because, sometimes the individuals don't actually have the full amount to write the check, so to speak. But if they do have the cash, it's a lot easier for you to be able to execute that. So, not without pros and cons, but because it's an individual and their finances are limited, they're not a strategic buyer, oftentimes the valuation they pay is going to be at the lower end rather than at the higher end. But again, there's benefits just the same to be able to sell to an individual. And on the next slide, the next part of selling your business could be to selling to private equity. And so there was a time many years ago when private equity only bought businesses that had a higher, for like $5 million EBITDA and higher. They were really looking for the bigger end of the SME market. So there are not a huge number of businesses in small business owners who have greater than $5 million on the bottom line as their return. However, that private equity category now has become reasonably competitive. So they are looking at smaller businesses, and they are acquiring companies today with even less than $1 million EBITDA. So lots of pros and cons selling to private equity. And first of all, one of those opportunities could be that they could be rolling up. I had some clients a few years ago who were in the pest control business, small business up in Sydney. They exterminated stuff, okay. 5 employees, they were doing $1 million turnover, but they were only doing 100 on the bottom line. There was an industry roll-up, private equity was involved. They ended up selling to Rent-A-Kill, who paid them their revenue. So a 10 times EBITDA for that. So, you know, it can be quite fragmented if you get involved in an industry roll-up. You can often get, you can often do very well from it when you sell up that way. So sometimes though, one of the cons in all of that is that even though they might present it to you as a benefit, as a pro, one of the cons could be that they'll only take a percentage of your business and that you've got to hang around as well. So you've got to keep that in mind, you know, because it could be a sort of a staged exit. And again, with private equity, I don't know, some of you might even be investors in private equity firms, you know, where they go out and acquire a portfolio of businesses and then they ultimately look to sell those on with a time horizon of 5 to 7 years. We've been involved in those funds as well over the years, but I think if you're in it and you're the business that's being bought, you've got to remember that, especially if you've still got a percentage of equity rolling, you're going to be hanging around for that period of time to get the second part. I've also written a couple of books. In my book, the $1 Million Payday one, there's a really good story from with a case study in it with the business owner who was involved in that and in an acquisition similar to that, who left 10% in it and has, like, he's underwater basically with his 10% now because he can't get it out because it's in a private equity deal. There's a bit of a story there. So I think the next slide is, yes, John Rood. So again, Built to Sell Radio, you can go and listen to it and hear the real story on it. He had a business called Next Step. This is so topical. This is amazing how this has come up now, because his business was one that had access to previous tests for the MCAT. Now, the MCAT is the medical exams that you have to do when you're going into university. So, you know, all this carry-on stuff up with the VCE. Yeah, VCE exams where kids have had they've had access to previous exams. So topical, it's amazing. But so it's a test. So his business was a test preparation business. He built it up to 10 million in revenue, and in a good year he made 30 or 40% margin on that 10 million. Nice. So very profitable. And he chose to sell it to private equity. So when he did sell it, they did ask him to roll it, roll some of it, and I think it was around 30%. So he spent a year or two in the business as well then as a senior executive, which often is the case that you have to do, and but he found that he just didn't like it. The couple of years that he was there, he just couldn't handle it. So he's out. So now he's sort of a cheerleader on the side, but he's hoping the business continues to succeed. But right now his 30% is at risk. So he has to wait for the private equity group to sell on their portfolio before he might get his return on that 30%. So every business is different. Again, if the idea of working in a company, in a management organisation, I had a 2-year earn-out when I sold my business. It was horrible. So if you have that, if you're okay to work for somebody else when you've been the chief cook and bottle washer, then you know that that's something that you've got to think about, depending on what the opportunity might be. Thanks, Wendy. And the third part of that, selling to a third party, could be to sell to a strategic. So what does that mean? That means looking for in an industry that you might be part of that could be 20 times bigger than you are right now, or a company that could be 20 times bigger than you are now. But you will really want to know what are the KPIs in that industry. You want to know how you're performing against those, or if you're not measuring them right now, get them in and have that as a specific target of where you want to actually get to. They have benchmarks that you have to be able to perform to. If you're below them, do what you have to do. If that's your end game, you want to sell to a strategic. If you're not reaching those benchmarks now, do what you have to do to reach them. Or you might need to change your strategy going forward. So pros and cons. Be great if you can sell to a strategic acquirer. Understand what you have to do, understand the KPIs. Thanks, Wendy. Again, another great episode to listen to. Now, Michael Lieberman, founder of this company called DataStay, and that business is an example of a niche within a niche within a niche of an industry. He created a business that stores CAD drawings for brake manufacturers. Okay? Niche within a niche within a niche. It's crazy. So he knew his industry very well. He knew his target market was brake manufacturers, and he focused on it with one very specific product. So who would be interested in, can you imagine what sort of a company could be interested in buying a business like that? There's a company called Autodesk who saw that taking the way that DataStay operated could allow them to expand into different verticals. They could just simply take exactly the IP that they'd created in that business, move it into other different verticals, and just replicate the business over and over and over without having to make the initial investment to create the business in the first place. So they could, that was architects, for instance, for companies who needed to archive their architectural drawings, things like that. So DataStay was acquired for 10 times revenue. That's an example. So 1 times revenue would be great, wouldn't it? For most people. 10 times revenue is outstanding if you can do that. So software companies, of course, that's a little bit different. They get better multiples. And if you have a business that has recurring revenue, that is such a guarantee to a future acquirer to be able to have some confidence in the revenue that's coming forward. So, and again, once again, if you haven't done the Value Builder questionnaire and you want access to it, just let me know, because will give you that a score on each one of those areas of risks that any potential acquirer would be interested in. So, think about what we do in our own lives now and what we pay for, whether we've recognised it or not. On the next, thanks, Wendy. Yeah. So, anybody other than me still subscribe to Netflix? Not Netflix. What's it called? Foxtel. Yes. Anybody other than me? A few of us still subscribe to Foxtel, which is like the example here, cable TV, if you like. Thanks, Wendy, it's got a couple, yeah. In this example is Comcast, okay? So we pay our, whatever it is, $100 a month for all the channels on Foxtel, and how many do we watch? Okay, no. I mean, I like to record the programs that I miss, because then I can watch them and fast forward through the commercials, because I hate the commercials. That's why I don't like to go to any of the catch-up channels, because I still get the bloody commercials, you know. So I pay for it, all right? So really, as this example says, you know, so instead of Comcast, read read Foxtel, you know, you get your 300 channels or whatever, and for what you pay, you know, you're paying possibly 20 cents, you know, per channel. But then, like all good parents, or even just really interested people, yep, we'll subscribe to Disney Plus and we'll pay our $12 or $10 or whatever it is. I don't know, it's probably more than that now. I don't know, it appears, you know, it just goes straight out of your credit card. You just don't even know about it. So people will pay a lot of money for stuff that they really like and really need. So we are strategic buyers of those things. That's a really, really good example that we personally do, okay? So, if you have something in your company, a product or a service that's highly differentiated, that could be irresistible to an acquirer, then my advice is double down on it. Just double down on that product or service and avoid the temptation to keep launching all new ancillary products to try and spread yourself too far and wide. Because the one thing that makes you unique will get you a significant premium. Okay. AutoCAD paid 10 times revenue for DataStay because they knew that they were archiving drawings that could literally plug and play everywhere else. They could take that software and plug and play it into any industry. So, first question I want you to answer today is, what's your plan to get to your end game? Is your plan to transition to your kids? Might be another slide that's got pros and cons. Are you planning to transition to the next generation of managers? That too has pros and cons. Transitioning to a third party, it's what most of your peers are planning to do. But underneath that, of course, there's the three broad strokes that we've already talked about. So hopefully that gives you a little bit of an understanding of the landscape. Okay, so the second question is by when? Are we all in our twilight?
Or do you want to wait till
If you don't mind, we might wait to the end, and then if I might answer it along the way, but if not, that'll be good. Okay, so with that in mind, we should all have a date, you know. Sit down, write yourself a date, have SMART goals, we all know what they are. If you don't have a specific date, then you're just going to be jogging, not training. Okay. So I know when I acquired FMI, it was 10 years. That was my end date. We were out by 10 years. And we did it at 9, which was great. So again, I think the next slide shows Wendy. Yeah, this is some data from the Exit Planning Institute that I spoke about early on, and that is that in the last round of survey work, they said that 8 in 10 owners were thinking about the end game, which is an incredibly different statistic to when that research was done 10 years ago. Yeah. 81% have plans to exit within the decade. Only 19% have no plans to exit. So I guess there's a lot here in the same camp as well. So by when? What's the next slide say, Wendy? Yes. So how much? So for some of you, that's just going to be a number. And whatever that number, that is success. All right? Yep. Very good. And yeah, it could be, that's just a dream number. And once you've hit it, you've hit it. That's fine. And it's aspirational. So no reason to back it up. That's just what you want to do. Thanks. So we're going to do our second Menti now. So I can wake everybody up because I've been talking a lot. Okay. Which of the following best represents someone who is wealthy for you? Are we finding it or not? Still. Stop moving. That's good. So that actually tracks with responses that we've had come in with the Value Builder questionnaire. Yeah, very good. And, you know, it's whatever it is to you that's important here in all of this. But that last one, having enough money to do whatever you want, whenever you want, has come in as the majority answer in the Value Builder questionnaires, as I said. So whatever that is to you, so that's your number. I just encourage you to get out a piece of paper somewhere and start brainstorming the life that you want to lead. After you've exit, you know, for many people, it could be that, you know, I want to travel. So, okay, if you want to travel, get more specific. Travel to where? How do you want to get there? Do you want to fly? Do you want to go by boat? Are you happy to fly economy? Do you want to fly first? Do you want to fly business? I won't fly anywhere unless it's business class. Okay, sorry. I'm not going to leave any, okay? I'm over it. I only get on a plane to Sydney business class. I won't even fly domestically anymore. When you're about to hit 73, that's it for me. I'm over the hill, okay? So, yeah, think about what is it. So what is the sort of money that you're going to need for to fund your future lifestyle? Where do you want to travel to? What cities? What countries? Private jet. I'm not a private jet person. I haven't reached that point. I'm sorry. So, okay. You know, for some people, they're happy just with a cabin, Mount Eildon fishing, like that. Mount Eildon. Never heard of Mount Eildon. Lake Eildon, fishing. So, whatever it is, just have a bit of a think about it. And once you've figured out what that is, then you're going to need to figure out what sort of a nest egg that you need for that. Now I'm going to show you a slide that's a little bit complicated. Bear with me, okay? But I'm not a financial advisor, but I'm just going to give you some demonstrations, okay? So this is actually, there's a few clicks in this, Wendy. Yeah. So the failure rate by withdrawal options. Do you want to just do the next click? Yeah, okay. So this is, on this axis, the probability of failure, and on the bottom axis, it's the amount of stock. Say you're investing, okay? If you take, what's the next slide one give us? Okay. If your withdrawal rate is as low as 3%, then the likelihood of running out of money in the next, of 100% of your money in the next 30 years is very low. If your withdrawal rate is much higher, then you're likely to run out of money sooner. So the yellow line says that if you are withdrawing at the rate of 7%, you're going to run out of money by age 50. We're just talking about everybody having a 30-year time horizon, because that's pretty much what it is these days. I mean, even Some of us go sooner. Unfortunately, my husband was one of those, and he checked out at 72. But I'm still here 6 years later, so you never know when you're going to go. So you've got to have enough money to live for probably 25 to 30 years is what we're saying now, to fund your lifestyle for that. So we've got to figure out what our nest egg needs to be in order to be able to fund that. And if we take, what does the next highlight? There we go. Okay, at age 70, if you take 9% of your business, 9% of your nest egg out, you are going to run out of money. Basically, that's, if you go to a financial advisor, they'll actually give this to you in far more detail and explain it probably much better than I'm explaining it. But don't worry, it's also in the ebook that's going to be available for you, so you'll be able to look at it more closely. It depends on the withdrawal rate over your time horizon.
Is this the assumption that what you sell is your total of your net investable assets?
No, it's actually on the assumption that you keep 30% of it, say, in cash like bonds,
Right,
and then put 70% of it into investable, other investable type of assets. Yeah, whether it's the stock market, property, whatever, portfolio of investable assets that you might want to go into. Yeah, that's the basic premise. So, if, say, for instance, you need $100,000 a year to fund the lifestyle of your dreams, well, great. Multiply that by 33, that's 3 years at 3%. You need 3.3 million. That's where you need to figure that out today. That's the sort of what you need to figure out, okay? What does the next slide say? Yep. So, if you want a 4% withdrawal rate, you'd have to multiply it by 25. Okay, those are the numbers. Now, once again, if anybody wants an easier way to do this, which I'm sure you would like, I can send you a link to another calculator that's called the Freedom Score that's inside Value Builder, and you can just do that for yourself personally. Put your numbers in and figure it out. So, let's just go to the next slide. How close are you to that number? Let's say, what does the next one say, Wendy? There we go. Oh, I'm ahead of myself here. The Freedom Point calculator, okay. Thank you. Let's say you want your $100,000, 3%, 30 years, you need 3.3. The value, let's say, excluding your personal residence right now, that you have 600-odd thousand in other assets outside your business. There's a little bit of debt on those. Thanks, Wendy. Then the net assets outside your business is 620,000. We go on to the next one. Your gap to reach your freedom point is 2.68 million. Okay, so you have to sell your business for 2.68 million to generate your $100,000 in order for you not to run out of money. And the next one says, on top of that, you have to add what we term frictional costs, which is this is a hypothetical, okay? So let's say you've got long-term debt in your business, which you've got to pay off. So you want that. You're going to have to pay an intermediary commission, whether that's a broker, M&A, whatever. You're going to have to pay some legal fees. We're talking about an assumption here. Let's say you've got a whiz-bang accountant who's going to get you down to a 20% tax rate on it, okay, maybe. But so on top of that, you've got to have another 32%. Those are the additional frictional costs that you might have to cover. So you'll reach your freedom point when your business is worth $3.8 million. Okay? Silence is golden. All right. Is that all clear as mud? Okay. All righty. Thank you, Wendy. Okay. Wall Street traders will refer to we'll have these, they call them, these terms are risk on, risk off. So you've built a business that's going to fund the rest of your lifestyle. Great, fantastic. When your business reaches that value that you've just determined gives you your freedom number, the longer you keep it above that, the more risk on you will be. You're putting it more at risk. And can you remember back in that first slide where we saw, you know, business owners have rode it over the top? So yeah, so instead of selling their business when they're actually in the growth phase, they try to time the market to some extent. Yeah. So this is really a way of trying to give you some understanding of what it means when you're in your business and you've got beyond your freedom point, then it's at risk from there on. Okay. So decisions are worth making to move on sooner rather than later in that case. So just really trying to encourage you to think about what your end game, what your end date might be. And if you think about that story about John Rood, who didn't get really what he wanted to get for his business because he left it too long. He rode it over the top. But, you know, don't think that when you go to sell your business that it's a one-time transaction. It doesn't happen that way. It takes a long time to actually sell a business. So if you want to be on the beach by the age of 60, then you probably should execute a transaction by the time you're 57. If you want to sell to private equity like John Rood did, then you could be waiting 5 to 7 years after that, you know, to actually get your money out as well. So just keep all those sorts of numbers and things in mind, and you will, you know, you'll be able to. It'll help you make those right sorts of decisions, which leads us to the next slide around timing. And for most, thanks Wendy, yeah. For most entrepreneurs that we talk to, what does the next one say? Yeah, timing. I went past that one already. So this is just a hypothetical. Typical owners, let's say owner A is tracking along quite nicely and wants to sell the business. Now, it's a very typical pattern, and in 2007, October 2007, seller A sold, and that was at a time when the market was not so good. October 2007 was when we hit the beginning of the GFC, if you remember. Yeah, okay. But really, they just sold in time and got out at what they thought was the top of the market. So at that time, they thought they were very happy. I have to tell you, we had somebody come along and made us an offer too good to refuse, and we sold our real estate business at exactly the same time. We were not selling our business. It was just there, and it was ready for sale. It didn't matter who came along. Our Allen Bond came along, and we just said yes, because that was it. If they hadn't come along, we would have just gone through the GFC like everybody else. But they did, they came along, and so we said yes, thank you. So seller A sold out then. Seller B sold out further down the track 2 years later. Now, this is really about considering that no matter what market you're selling in, you're investing in the same market. It's like, you know, you buy and sell in the same market. You're going to invest your money in the same market at the same time. So the impact might not be all that great. So if you think you can time the market, you really can't. And you know, it isn't that it isn't going to make a huge difference. A lot of M&A professionals will tell you that the difference between the two is probably 2 multiple turns. Maybe Trevor, you've got some insight into that as well. Thanks, Wendy. So if they'd gone out there and invested their funds at the same time, so seller A, there's the slide that shows you the difference. So seller B sold in March 2009. They both got their money in the market. Seller A got their money in the market earlier because they'd sold 2 years earlier, but they're in the same downward market. So now they're both in the same upward market. Again, as it's turned out, seller B has actually made more money. This is the exact mathematics on a. They're actually real people, but we can't disclose who they are and what's actually happened. So the underlying premise in all of it is, please don't try to time the market. Just do it when it relates to you personally and what it relates to your number, okay, more than anything. So it's a bit of a fool's errand if you try to time it. So I think Covey was right when he said try to think to begin with the end in mind. And once you've figured out what number it is that you're after and what your end game is going to be, not only what, but by when and how much you're hoping to pull out and how close you are to that number today, once you can figure that out, you're a lot further ahead than most, quite frankly. And again, if you're interested and you would like to go through the Value Builder tool and you haven't already done so, then I certainly make it available to you. So in summary, yes, here we go. Know your end game. Don't jog, train, okay? And nail those 4 questions. What's your end game? By when? How much? And how close are you? And somebody that I've been delighted to be working with recently who's taken advantage of all of this is Alex Stock, which is great. Alex, maybe you could share your little experience already with how just getting some focus in those drivers has been for you.
Yeah, so we started working April time,
yeah,
and started to go to the Value Builder system, and reading Build to Sell, listening to Build to Sell was really helpful on that as well. In marketing professional services, we've always really struggled to get our head around productizing what we do, and to give a sort of practical example of where that's ended up is we used to, or try to develop products and services guides internally for us so that we could more easily offer and sell, knew what we were offering and selling to our clients. We had one for the marketing consultancy side, one for the graphic design and website of the business, and I reckon those two combined, they must be 60 pages, they're ridiculous, they're completely ridiculous. And going through this entire process of Value Builder, we've now got the entire business on one sheet of paper, and it's not 2 business units, it's now 4 business units, but reduced all essentially what we offer to 2 or 3 different productized services for each department or business unit, which has been really, really good, because then that enables us to go into the scale phase much more easily. It enables us to communicate much more clearly with our customers about what they're going to get, how we're going to service it. It makes quoting quicker, it makes it more effective, it makes it quicker for us to put together proposal presentations, the whole thing, and that's just one output of it. I don't know when we're going to exit, hopefully I'm not going to drop down dead. I have done all our wills and all that kind of stuff, so if myself and Patrick do pop our box together, then we know where the business is going. I won't tell you in case you knock us off. So going through that whole process has been really, really effective. And I mean, we've increased our billings in the last 12 months, our billable hours by about 40%, so over the last year. And part of that has been the simplicity and clarity. I'm not a detail-focused person at all, so having Georgia and Celia, who are two of the departmental managers and the next generation of managers who are very much detail-orientated, going through the process with Kerry has given them a lot of confidence because I've been able to give them structure, and we didn't have that before because I'm not a structured person. So the whole process has been really valuable to then, once we get into this endgame stuff, it's actually very transferable. I'm going away for a month again in December, I was away for a month again in June, July, and the business runs better because I'm not getting my fingers into things that I shouldn't. And now I'm at a point where most of the emails from the team are, can you please pay this invoice? And that's it. So it's really enabled us to de-risk me, and I don't mean me, I mean, key person risk. And also next year we've got one of the ladies that works in the team coming back off mat leave, taking up a new business and it's a sales and marketing role. And she and I have got every confidence she knows exactly what she can do and should be doing because it's all productised. And that going through the value builder system has made that very, very clear. So it's been great.
Yeah, terrific. Thanks, Alex. Yep. And I'm heading myself off to the States again in March to the next Value Builder Conference, which I've been going to since they started them in 2016, every year. And interesting to see how John's going with his training for the Ironman this time around. Anyway, so thanks, Wendy. There's another one. There's another 2 slides, that's all. If you'd like the ebook, there's the QR code. It'll take you to the system to be able to download it. You can have that one. I'll leave it up there for a few minutes. And the next one, when you've done that, speaking of, I'll let you all finish that one off if you're still doing it, the previous one. Whether you've, no matter where you are in your business right now, no matter what stage your business is at, you need this, okay? It's just a checklist to help you understand what you need to have accessible for anybody if something happens to you and your business. So your assets that are in the business, the key people, your advisors, bank accounts, digital data, passwords, etc. That's just a checklist for that to help you to put all that together. Which you don't have yet, Alex, because I only did it last week.
Something for January.
Yes, I didn't bother with it since you're going to be away.
Andrew, you had a question?
Yes.
Yeah, just got one other scenario, Kerry, which I don't know whether you see much of, but what about merger first, then sell?
Yes, or merger and oh shit, it doesn't work and we're demerging right now with a client.
Yeah. Okay. So you see all of that?
Oh yeah, see that as well. Yeah, I can tell you that this particular client, I have actually been working with them now for nearly 15 years, and we went through the merger, but now 10 years later the merger isn't quite working, and it's a demerger, and that is far more difficult than the merger. Yeah, so.
And not a pleasant situation.
It's not acrimonious, but it is difficult.
Thanks, Kerry.
Yeah. True.
Kerry, I love what you do. Selling businesses, I see that many that aren't ready for sale.
Yeah.
So people
I
like
prepare
yourself, you prepare them, make the job that much easier, that much more enjoyable,
Yeah.
and just that much rewarding for everyone involved. So
Yeah.
the work that you do is greatly appreciated. When you talk about the end game or getting sale ready, typically how long do you tell people they need to start getting ready? And are you factoring in the actual process of the sale?
So
Or are you just talking about getting ready for it?
I do recommend, if people can, 3 to 5 years. And in that 3 to 5 years, depending on where they're at already, there's a timer as well. So another little tool, the timer, that says when we've worked out your number, or when do you think you want to be out? If you can give yourself 3 to 5 years, that's great. If it's sooner than that, well then understand the hurdles that you have to jump to get there, and the sale process itself that we include in the timer, which can be more than 12 months. I mean, I talked about one of my clients right now, if it's an internal sale, it's still 12 months, for that to happen. I have another client that we've already been going 12 months. They're over in Adelaide, had a few nibbles, but still can't get people across the line. It's more than 12 months. On the other hand, it could be sooner. It depends, but most of the time, realistically, would you say 12 months for a sale?
It depends what you own.
It does.
So if a business is sale ready, actually time in the market can vary.
Yes.
It depends whether someone's trying to do it themselves or someone's using third party, whether it's their accountant or a broker, or I don't know how much of that process you get involved with. But it depends on the size of the business as well.
Yeah. I personally typically, I'm not a broker, so I personally typically don't get involved in the actual sale, other than being a professional best friend with the business owner to help them understand and get through the emotion, quite frankly, because as I talked about right at the beginning of the year, leaving your business is more than just your business. It's, your estate planning, it's your personal side of things, your family, all the other stakeholders that are involved, and of course your financial side of it as well. And
your identity.
Absolutely your identity that's tied up in it, that I talk about. I spend a lot of time working that out with people. A couple of clients recently that are going through that whole, I just don't know what I'm going to do when I've left my business. I'm an example of what you can do, okay? So I do what I do because I love doing it, And nothing is perfectly fine. If that's what floats your boat, it's perfectly fine, absolutely. But, some people, already told you, I think, the story of my uncle who, after selling his 14 different companies, he was going to play golf and, travel more and do all that sort of stuff, which is great. But 12 months later, he was in clinical depression because it wasn't enough. It just wasn't enough, and his whole identity had gone. Got through it, and everything was fine, and literally the grandkids were his life after that, which was beautiful. So, but you don't want to go through that in the first place. Would that I had the opportunity to actually experience that sort of stuff. So, and I know, but you know what? Things change. After 28 years, I have just resigned as the secretary of the South Melbourne District Sports Club. And come the 15th of February, I will no longer be running the Cricket Blast program, also after 28 years. And I mean, they're very worried about what they're going to do now. But those are things that you get yourself involved in. I love doing that sort of stuff, but I don't want to keep doing it. I'm done.
You made the observation, very valid, about when you're looking to make a private sale and you have an interested party,
Yes.
but they haven't got their ducks in a row in terms of how they're going to fund it.
Yes.
At the risk of sounding like self-promotion, which it is.
Yes. No.
There's an exercise we've done for a lot of prospective
Perfect.
sellers of businesses.
Yes.
You run through a debt sizing option. So,
Yes.
so it's not an approval,
No.
but they have a reasonable degree of confidence that all other things being equal,
Yep.
that this business could sustain a debt of a certain amount.
Yes.
So they can talk to a potential purchaser with some degree of
Perfect.
confidence. Then they know what the equity gap is.
Yes.
Rather than one of the biggest problems is people go and buy businesses and they raise a sum of equity, and we always say to them, how do you know you raise the right amount?
Correct.
Because if you raise too much, you've got a lazy balance sheet, and if you haven't raised enough, then you're asking a lender to take
Correct.
equity risk, and the deal will go.
Yeah, and so also, one of the things I always say to people, they've got to come at you with two parcels of money. One, what they're going to pay you for the business, and the second parcel is the working capital.
And you'd be familiar with the private equity firms, they'll often
Correct.
get a staple debt offering
Yes.
attached to the
Yes. Yes. There's a whole lot of intricacies around all of that, so none of that, we certainly haven't got time to go into anything.
I'm just
much
thinking
further
about a
detail.
perspective, I mean, if you're looking at doing an MBO, selling to your management, doing a debt sizing, I know it's not a bad idea, right? It's a conversation you can then have with your management about what's achievable and what's
Absolutely.
not.
Mhm.
So if anyone here is thinking that's something that you'd happily have a conversation with them about, don't you?
Yep, and ESOP, that's, that employee share plan arrangement, that sort of thing, is also another valid option for, exiting as well, another way you can do it. But it all boils down to actually figuring out your end game at the end of the day. First things first, that's another wonderful Stephen Covey principle. Yeah. Thank you.
All right, thank you.